Nifty is up about 35 odd points, so marginally positive opening. The Sensex is up about 90 points as well.
Inflation still remains well above the target in major economies.
Now the Nifty is holding up with a triple-digit gain. The Nifty is up 120 points.
It is a gain of 160 points on the Nifty. We have the mid-cap index, which is also surging up around 250 points.
It's up 162 odd points at this stage, which means that we've basically taken out the 20-day moving average for the market. The market kind of failing to build on gains, and we are going to once again close under the 20-day moving average, 17,860. It may be a matter of time before we cross it.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are the top stories for this evening. Indian indices closed with gains after the Reserve Bank hikes rates on expected lines. Sensex and the Nifty gained nearly 1%. Bank stocks go on a roller coaster ride, with the Nifty Bank index closing slightly in the green. Reserve Bank-led rate-setting panel hikes policy rates by 25 basis points to 6.5%, maintains its accommodation withdrawal stance. Governor Das defends the rate hike, says further calibrated monetary policy action is warranted to keep inflation expectations anchored. The MPC also projects a growth of 6.4% next fiscal. TCS bags its biggest deal of the year. The £600 million transformation deal from Phoenix Group pushes the IT major 2% higher. IT stocks also rise in tandem as the street cheers the deal win in a challenging global environment. A strong January loan growth helps Paytm jump 16% even as analysts cut loss estimates. Zomato too climbs 9% higher after the founder signals a move towards profitability, and analysts hope for a good Q3 report tomorrow. Adani Group continues to recover lost ground as the management sharpens its focus on deleveraging. Adani Enterprises share price doubles in the last 3 days. However, the current market price remains 50% less than its 52-week high. Reserve Bank dispels fears over banking sector's exposure to Adani Group. Governor Das says Indian banking sector is too resilient and strong to be affected by an individual case. All right, well, those were the top stories this evening. Let's also tell you what we have lined up and in store for you. We bring you expert opinion from Mahesh Patil of Aditya Birla Sun Life AMC. We also have key comments from the Reserve Bank of India Governor Shaktikanta Das on MPC's rate hike decision. Well, let's get to the first story then. The rate hike by the monetary policy was on expected lines, supported by the markets today. The Nifty and the Sensex closed with gains of over 0.5%. The mid-caps rallied the most, closing close to 1% higher. Financials closed in the green after losing early gains through the trading session. The Nifty Bank index closed with minor gains among sectors. Nifty Metals gained close to 4%, followed by the IT and the Pharma index, both closing over 1.5% higher. Well, let's get some market opinion then. Mahesh Patil of Aditya Birla Sun Life AMC says the Nifty earnings have shown reasonable growth this time, adds that new age companies have corrected well.
If you look at the Nifty earnings numbers which have come in till now, it's still a reasonable growth. We have seen a growth of almost 16-17%, which is not bad considering the fact that overall there has been slowdown in terms of exports, and domestically also there has been kind of a slowdown on the discretionary side. Consumer durables and other sectors have seen a marked slowdown after the festive season, and overall rural economy, which was supposed to pick up, is still gradually moving up. So on this backdrop, I would say that the growth numbers for the Nifty earnings is still fairly good. Good thing is that we haven't seen much on aggregate basis any downgrades. New age tech companies have, you rightly said, they're focusing more on profitability. Earlier it was more of growth, and considering the fact that markets, we've seen a good correction in some of these stocks here as well as globally, and focus is now back to profitability, and we've seen some of these companies cut down on their costs and to some extent sacrificing growth after the IPO and the post correction. We looked at some of these names and try to really value them more now on profitability rather than the revenue multiple or the overall subscription base. So I think with profitability inside, it's now much easier to value them, say probably 3-4 years down the line on EBITDA multiple, and then look at a fair value.
All right, let's get to the second story now. The Reserve Bank of India's Monetary Policy Committee has hiked policy rates by 25 basis points, maintaining its accommodation withdrawal stance. Governor Das defended the rate hike, says further calibrated monetary policy action is warranted to keep inflation expectations anchored. Listen in to what he had to say.
Core inflation, however, remains sticky. Looking ahead, while inflation is expected to moderate in 2023-24, it is likely to rule above the 4% target. The outlook is clouded by continuing uncertainties from geopolitical tensions, global financial market volatility, rising non-oil commodity prices, and volatile crude oil prices. The MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break the persistence of core inflation, and thereby strengthen the medium-term growth prospects. Liquidity remains in surplus with an average daily absorption of 1.6 lakh crore under the LAF in January 23. The overall monetary conditions therefore remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. Inflation for Q3 22-23 has turned out to be lower than our projections. Core inflation, that is CPI excluding food and fuel, however, remained elevated. On the assumption of a normal monsoon, CPI inflation is projected at 5.3% for 2023-24, with Q1 at 5%, Q2 at 5.4%, Q3 at 5.4%, and Q4 at 5.6%. The risks are evenly balanced. Monetary policy has to be tailored to ensuring a durable disinflation process. A rate hike of 25 basis points is therefore considered as appropriate at the current juncture. Real policy rate has been nudged into positive territory. The banking system has moved out of the Chakravyuh of excess liquidity. Inflation has shown signs of moderation and is moderating, and economic growth continues to be resilient.
All right, Lata Venkatesh is standing by with her take on the RBI monetary policy.
Well, the rate hike was on expected lines, but what was least expected was that the Reserve Bank will not give any guidance about the future. In fact, many believed that they would, through their stance or in some other fashion, indicate that this is the last of the rate hikes. We got no such indication. In fact, Reserve Bank resolutely saying that it refuses to guide on whether this is the last hike, will there be more hikes, will they change their stance, nothing. Maybe a wise thing to do when there's so much uncertainty. The second surprising part is that inflation numbers forecast for next year perhaps are slightly more than what the street expected, which is a bit of a comfort because when the actual numbers come out lower, people will be happier. But 5% for the first quarter, April, May, June, is not the average on the street. It's 4 point something, maybe 4.8 or 4.7. So the Reserve Bank has left itself some elbow room on inflation forecast. Growth is the big surprise. Forecasting 6.4% for FY24 is clearly an outlier number. The average I got on the street was 5.8 to 6%, with several marquee economists expecting even below 5.8% in terms of growth. So maybe the RBI knows something we don't, or it's just being optimistic. The splendor of this policy is the non-monetary policy announcements. There were several of them. The TREDS exchange, where small companies can discount their bills a little easily, has been embellished a little, may or may not work. The penal interest rates banks charge is now going to be moderated. There is a lot of announcement on green deposits and green bonds, which will come. The foreigners coming into India can also use their phones to pay over UPI. And the most important thing, insurance companies can use their bonds for lending and borrowing on the CCIL. This may mean a more deeper GSEC market. So non-policy announcements, it makes it a many-splendored policy.
Okay, all right, Lata, thanks very much for that. Well, meanwhile, in the US, Fed Chairman Jerome Powell said the United States is seeing early signs of disinflation. Powell anticipates progress this year on the Fed's target to bring inflation down to 2%.
These are the very early stages of disinflation. So the services sector really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. The labor market's extraordinarily strong. And by the way, it's good. It's a good thing that inflation has started to come down without it. That has not happened at the cost of a strong labor market.
All right, and reacting to the Fed Chairman Jerome Powell's comment on inflation, Ed Yardeni of Yardeni Research said inflation will come down to 3 to 4% this year.
Disinflation has started, so at least he's acknowledging that we're seeing some progress in the right direction on the inflation front, and he has said that he's, I think, pleased with what he's seeing in disinflation in goods. Where he wants to see progress is in services, and we're just going to all have to wait and see how that plays out. I think inflation is going to come down to 3 to 4% this year, and then after that, I think it could go lower. And I don't think it's going to take more than a 5.25%, 5.5% Fed's funds rate, which is what they're aiming for right now.
All right, well, let's move on then. TCS has bagged a £600 million transformation deal from Phoenix Group. The deal is the largest BFSI products and platform deal for the IT major in the last 3 years. The stock closed 1% higher following the news, with other IT stocks following suit. Reema's here with the details.
Thanks so much for that. So TCS is higher because it's won a very large deal, the largest deal win in FY23 with a size of more than £600 million or close to $700 million US dollars. Now this deal is won from Phoenix, which is a UK-based insurance company. Phoenix is an old client of TCS, but now the company has got an extension of a contract, a new, growth and transformation kind of deal, which is priced or sized at £600 million. Now, Phoenix Group had made an acquisition of a company called Reassure in 2020. So they want TCS to help with the integration, the M&A related work. They also want to enhance the customer experience for Reassure's policyholders. So that's the scope of the deal. Historically, TCS classifies or buckets its deals into cost and optimization deals and growth and transformation. So for Phoenix now, this will be a growth and transformation kind of deal, and that's a big positive. But the bigger positive is that in this macro uncertainty, large deals had dried up. So the fact that TCS has gone ahead and won a large deal is testimony to the fact that their pipeline is still very strong and their clients are still looking at large deals. So it's the fact that they won a large deal in BFSI in the UK region in a challenging environment is what's positive.
Okay, all right, Reema, thanks very much for that. Shree Cements posted a largely in-line performance for the quarter. However, the profit missed estimates owing to higher finance and depreciation costs. Nigel is here with more.
Well, Shree Cements' numbers were more or less in line with what we were working with. On the top line, there was a small miss on the revenue aspect. This despite the fact that volumes were higher than what we worked with. So volumes were higher by close to around 100,000 tons odd. That told you that realizations were a bit of a disappointment. Volumes, in fact, were up by close to around 23% on a year-on-year basis, and that helped out in terms of operating leverage. Because on a cost per ton, well, those costs were lower, whether it was other expenditure or the freight and forwarding costs or even employee costs. On a per ton basis, for volumes going up by more than 20%, well, they didn't increase that much, or some of them, in fact, were a little bit lower. And management said that they're continuing to focus on cost efficiency. The profit number, though, missed estimates, but that's not a big worry. That's because, in fact, they expanded capacity, so depreciation was higher, finance costs were higher, and effective tax rate as well was higher. So that's what led to a bit of a miss on the net profit number, but the operational performance was more or less in line. The management also went on to say that they're focusing on scaling up to around 80 million tons in terms of capacity.
Okay, all right, Nigel, thanks very much for that. Time for a break now, but stay tuned. We'll be back in a jiffy with all of the other top stories.
Suresh. Yes, brother. Please take